Tonight, I'm going to tell you something that sounds like a conspiracy until you realize it's just arithmetic. Most people think market crashes are caused by a headline, a war, an election, a scandal, a black swan. But those are sparks. The real cause is always the same. The system quietly becomes so overextended that it can't absorb stress anymore. And when it reaches that point, the crash isn't random, it's scheduled. Here's the part that should make your stomach drop. Global debt is still around $251 trillion, more than 235% of world GDP, according to the IMF. And U.S. gross national debt is now above $38 trillion, about $38.43 trillion reported in early January 2026. These aren't trivia numbers. These are pressure numbers. They tell you one thing. The world is not growing. It's refinancing. And when refinancing is the real engine, one indicator controls everything. One line on one chart decides who keeps their wealth and who watches it evaporate. In a moment, I'm going to name that indicator. And I'm going to tell you the exact mistake that makes smart people miss it every single cycle. But first, understand the trap. Debt doesn't kill you when it's big. Debt kills you when it becomes expensive to carry. When carrying costs rise, behavior changes. Governments cut or borrow more. Companies stop hiring. Consumers pull back. Banks tighten lending. And suddenly, the economy that looked strong is revealed as a fragile structure held together by cheap money. That's why crashes feel sudden. The collapse isn't sudden. Your awareness is sudden. Now here's the shocking claim said as plainly as possible. Crashes are not accidents. They are scheduled consequences of multi-stage overextension. And once the system crosses a certain threshold, the outcome becomes mathematically inevitable, not because the universe is evil, but because cash flows have limits. Debt forces behavior. It forces refinancing. It forces selling. It forces institutions to choose survival over optimism. By that point, it's not about feelings. It's about who can meet obligations without being forced to liquidate. Now, the indicator that decides your wealth is the yield curve, specifically the spread between short-term and long-term U.S. Treasury yields, like the 2-year versus the 10-year. And here's the key. When the yield curve inverts and then begins to re-steepen, it's not predicting a crash like a fortune teller. It's recording stress in real time. It's the bond market saying, we don't believe the next 12 months are stable enough to accept a lower return for waiting. You've heard people dismiss it. This time is different. The economy is resilient. We have better tools now. Listen carefully. The yield curve does not care about narratives. It doesn't care about your favorite stock. It doesn't care that technology is amazing. It cares about what borrowers must pay next quarter, next year, and whether the whole structure can refinance itself without breaking. And this isn't vague. There's a record attached to it. Reuters reported that the U.S. 2-year to 10-year inversion that began in early July 2022 became the longest on record by March 2024, surpassing the previous record from 1978 based on Deutsche Bank's note. Longest. On record. That's not a vibe. That's a historical extreme. Now I'm going to reveal the machine behind it, and I'm going to do it systematically. Not with hype, with a pattern. And I want you to stay with me for one reason. Once you see the pattern, you'll stop getting blindsided. And you'll start noticing the warning signs months before the crowd even realizes the game has changed. Here's the pattern. 4 stages. So simple it feels insulting. But it's the same structure behind the biggest crashes in modern history. Stage 1, the setup. A shock hits, war, recession, instability, and policy responds with easier money, cheaper credit, and confidence restoration. This stage feels responsible. It feels like rebuilding. Liquidity rises, risk feels manageable, and the system rewards exposure. Stage 2, expansion and overextension. The medicine becomes the addiction. Credit expands faster than productivity. Asset prices rise faster than incomes. Debt ratios climb. Leverage hides inside respectable things. Mortgages, corporate bonds, sovereign deficits, carry trades. This stage feels like a new era. People stop calling it a cycle and start calling it destiny. Stage 3, crisis and loss of control. Constraints show up. Inflation appears. Currency weakness appears. Defaults begin at the edges. Policymakers tighten to regain credibility, or markets force them to. The yield curve inverts. Because short-term rates rise and long-term growth expectations fall, this is the system failing a stress test, and the signature symptom is denial. People insist the warning signs don't matter anymore. Stage 4, the inevitable outcome. The system pays the bill through collapse, inflation, devaluation, defaults, or a mix. This stage is not one event. It's forced behavior, forced liquidation, forced cuts, forced repricing. Wealth doesn't disappear because the universe is mean. It disappears because leveraged claims cannot all be honored at the same time. Now you might be thinking, okay, nice theory, prove it. Good. Let's prove it 3 times. Different eras, different headlines, same mechanism. First, the 1970s stagflation era and the Volcker shock. Setup, after World War II, Bretton Woods in 1944 anchored global trust. The dollar became central and linked to gold for official convertibility. For years, that system created confidence. Trade expanded, capital flowed. The U.S. could finance commitments cheaply. Expansion. By the late 1960s, U.S. fiscal expansion, Vietnam War spending and domestic programs, ran alongside a growing supply of dollars held abroad. Foreign governments accumulated dollars, while the gold constraint stayed real. As dollars multiplied, convertibility became fragile. Then, in August 1971, Nixon suspended the dollar's convertibility into gold, the Nixon shock. That was a structural release of restraint, not chaos instantly, permission for overextension over time. Crisis. Then energy shocks poured gasoline onto the system. The 1973 OPEC oil embargo. Later, the Iranian Revolution in 1979. Inflation hardened into a regime. Policymakers faced a brutal choice: tolerate inflation and currency weakness, or tighten and risk recession. Volcker took over in 1979 and rates surged. Liquidity tightened. The bond market became the witness. That era is remembered because credibility and inflation were in open combat. Outcome, the early 1980s recession. A brutal downturn, but the bill was paid. Inflation was crushed at a painful cost. Not mystery, mechanism. Second proof, the late 1990s boom and the dot-com bust. Setup, the early 1990s recovery built confidence. Globalization suppressed goods inflation. Productivity improved. Monetary policy credibility strengthened. And markets learned a dangerous lesson. When trouble appears, the Fed responds. That belief lowered perceived risk. Lower perceived risk is the first ingredient of leverage. Expansion. Capital flooded into technology and internet companies. Narrative replaced earnings. Users replaced profit. IPOs surged. Companies with minimal revenues reached massive valuations. Then 1998 happened. Long-term capital management revealed how leverage can amplify small mispricings into systemic danger. The rescue taught markets another lesson. Even sophisticated leverage might be saved. Overextension learned it had a parachute. Crisis. The Fed tightened into 1999 and 2000. Short-term rates rose. Long-term investors began doubting the dream. The yield curve flattened and inverted around 2000. The bond market wasn't impressed by the story. It priced the cost of money and the probability of slowdown. Financing tightened. Easy capital vanished. The companies that needed cheap money to survive, because profits weren't real yet, hit the wall. Outcome? The bubble popped. Layoffs spread. The early 2000s recession followed, dated March 2001 to November 2001 by NBER. Again, pattern. Third proof, the housing bubble and the 2008 financial crisis. Setup, after the dot-com bust and 9/11, policymakers feared deflation and stagnation. Rates were lowered. Credit became cheap. Home ownership was promoted culturally and politically. Securitization promised that risk could be distributed. The medicine was meant to stabilize the economy. Stage 1 always looks like rescue. Expansion. Housing became a leveraged speculation engine. Mortgages were originated, packaged, sliced, rated, and sold globally. Banks increased leverage. Shadow banking grew. Home prices rose, which made collateral look safer, which justified more lending, which pushed prices higher. This is the signature. Rising prices are treated as proof of safety. Crisis. The Fed tightened in 2004, 2006. Adjustable rate mortgages reset. By 2006, cracks appeared. In 2007, stress spread through structured credit. Liquidity disappeared where people assumed liquidity was guaranteed. Interbank trust weakened. The yield curve had already inverted in 2006 to 2007, warning that policy tightness and credit stress were rising. When the curve inverts, banks that fund short and lend long see margins compress. Lending tightens precisely when the system depends on credit most. That's loss of control. Outcome, the 2008 forced liquidations, a global freeze. The Great Recession is dated December 2007 to June 2009 by NBER. Again, pattern. Different headlines. Same machine. Now we do the uncomfortable part because history becomes a mirror. We apply the same 4 stages to today, not with politics, with check marks. Setup. 2008 trained the world to treat central bank intervention as permanent. Then 2020 reinforced it. Rates went historically low. Quantitative easing became normal. Governments ran massive deficits to prevent collapse. That stabilized the world and rewired incentives. When risk is rescued, risk multiplies. When borrowing is rewarded, debt grows. Check. Expansion. Global debt around $251 trillion, above 235% of world GDP. U.S. gross national debt above $38 trillion. And at this scale, debt isn't a side issue. It becomes the core system, a refinancing machine. Everything depends on rolling liabilities forward at tolerable cost. Verified. Crisis. Inflation forced tightening. Short-term rates rose. And what did the yield curve do? It inverted. Then it stayed inverted for historic lengths. Reuters reported the 2 as 10s inversion that began in early July 2022 became the longest on record by March 2024. That is the bond market printing a warning in capital letters. Near-term funding stress is higher than long-term confidence. Undeniable. Now listen, because this is where retention usually dies in finance videos. People explain the yield curve like a textbook and the viewer's brain shuts off. So I'm going to make it visceral. Imagine the entire economy is a giant company that must refinance its debt every year. If your short-term borrowing cost jumps, you have two options: earn more or cut spending. If you can't earn more fast enough, and most systems can't, then you cut. That cutting is recession. It's not a theory, it's a cash flow response. Now here's the part most people miss. The danger isn't only that the curve is inverted. The danger is what happens when it stops being inverted. Because the curve can re-steepen for two reasons, and both can hurt. Scenario 1. Short-term yields fall fast because the Fed cuts or markets expect cuts, usually because something is already breaking. That's the curve saying the system is shifting from fight inflation to stop damage. That's often when risk assets get punched because the cut confirms weakness. Scenario 2. Long-term yields rise because investors demand more compensation for inflation, debt risk, or credibility risk. That's the curve saying, we don't trust long-term stability at today's price. That can crush valuations too, because higher long-term yields change discount rates and financing costs. So when people say, oh good, the curve is normalizing, you should ask one question: normalizing because we healed, or normalizing because something snapped? This is why your wealth gets decided before the crash. Not on the day of the crash. Before it, when you choose whether to stay fragile or become resilient. Now, I'm going to make this personal, because this is where engagement spikes. You recognize yourself in the mechanism. Most retail investors weren't trained for cycles. They were trained for a regime where buying the dip worked for years because liquidity was abundant and rates were low. That creates a reflex. Risk is rewarded. Overexposure is rewarded. Concentration is rewarded. Check. Then stage 2 hits you personally. Leverage and concentration. Maybe you didn't use margin, but you used something similar. You concentrated into the most rate-sensitive assets. You chased what worked last year. You assumed liquidity would always be there. You assumed drawdowns were temporary and shallow because they usually were. Verified. Stage 3 is where your psychology gets tested. Volatility rises. Cash starts earning yield again. The cost of being wrong rises, and the yield curve stays inverted, telling you the money market is pricing stress, not comfort. Your portfolio is now living in an environment where time is expensive. Undeniable. Stage 4 is where wealth gets selected, not just priced. People lose wealth in crashes for 3 mechanical reasons. 1. Forced selling. They need cash. They sell into weakness. They lock in losses. 2. They hold the wrong type of risk. They own assets that require cheap money to justify their price, and suddenly money isn't cheap. 3. They don't have a rule-based plan. So emotions become the plan. Panic becomes the plan. Regret becomes the plan. And this is why the yield curve decides your wealth. Because it tells you when the system is moving from expansion to constraint. It tells you when the refinancing machine is beginning to choke. Now we have to talk about the biggest lie that spreads right before stage 4. It always sounds intelligent. It always sounds comforting. And it always fails. This time is different. Sometimes it's American exceptionalism. We issue the reserve currency. Sometimes it's modern optimism. The Fed has tools. Sometimes it's technology will save us. Technology can drive productivity, yes, but it does not eliminate refinancing schedules. It does not erase the trade-off between inflation and growth. It does not cancel the fact that when debt becomes expensive, behavior changes. Reserve currency status can delay pain, but delay can increase the eventual adjustment because leverage grows larger in the delay. Central banks can cushion, but they cannot erase trade-offs. Cut too early, inflation returns. Stay tight too long, credit breaks. That constraint is stage 3, and the yield curve is where the constraint becomes visible. Now here's the actionable part, because if the viewer doesn't get practical steps, they click away. This is educational, not financial advice, but I'm going to give you a practical survival framework you can apply immediately. First, stop watching headlines for crash timing. Start watching system signals. In a leverage-driven world, the system signal is the yield curve and credit conditions. Headlines are the theater. Funding is the engine. Second, measure fragility. Ask yourself, honestly, if my portfolio drops 25%, can I hold? If the answer is no, you're not investing, you're renting risk, and renters get evicted in stage 4. Third, build liquidity on purpose, not because you're bearish, because liquidity is freedom. It's the difference between choosing and being forced. Stage 4 punishes forced behavior. Fourth, reduce concentration in rate-sensitive exposure. If most of your portfolio needs low rates to look attractive, you're betting on a regime. Regimes end. Fifth, use rules. Before you need them, decide your rebalance triggers, decide your maximum drawdown tolerance, decide your cash buffer, decide your no leverage rule. The people who keep wealth are often the people who removed fragile failure points. And now I want you to engage with this video, because engagement is how this reaches the people who need it. In the comments, write one word: curve. If you understand why the yield curve isn't a prediction, why it's a pressure gauge, write curve. And if you want, add your country, because the cycle hits different markets differently. Now, the final warning: the pattern is not optional. Setup leads to overextension. Overextension leads to constraint. Constraint leads to a bill. The only variable is how the bill is paid and who pays it. We have the debt. Check. We have the record long inversion that signals constraint. Verified. We have rising servicing pressure in the system. Undeniable. So if you want to know what will decide your wealth before the next crash, it's this. Do you recognize the stage transition early enough to stop being fragile? Because crashes don't just destroy value. They select. They separate the prepared from the overexposed. They punish those who whispered, "This time is different." And they reward those who understood the machine. Now here's what I want you to do. Subscribe, not for my ego, but because the next video completes the system. In the next video, I'm going to show you how the machine was built. The policies, incentives, and financial plumbing that turned the world into a refinancing treadmill, and why the next stage of the pattern always looks impossible until it arrives. So subscribe, turn on notifications, and watch the next video the moment it drops, because in the next stage, the market will not wait for you to feel ready. It will move first, and the people who keep their wealth will be the ones who saw the signal before the noise.